evening, everyone. On behalf of Peaceful Minds Haven, I want to welcome you to our financial web series, Blueprint for Financial Success with Jes from New York Life. We're so glad you could join us tonight. For those who may not be familiar with Peaceful Minds Haven, we are a nonprofit organization dedicated to promoting mental and maternal wellness through advocacy, education, and holistic care. Our mission is to empower individuals and families, especially those in marginalized communities, to prioritize mental health and well-being. The financial series is an extension of our mission because we recognize that financial security is deeply tied to mental health. Uncertainty around finances and this can also amplify stress and anxiety, impact postpartum recovery, and influence the stability of family dynamics. By hosting these free sessions, we hope to equip you with tools and strategies to navigate financial challenges, create generational wealth, and build a solid foundation for your family's future. Money matters can feel overwhelming, but knowledge is power. And tonight and throughout this series, we'll explore actionable steps toward financial stability and how these steps can positively influence your mental health and overall well-being. Thank you for being here and for investing in yourself and your future. Let's dive in and learn together. Jes?
All right. Thank you so very much for the introduction. That was very well said. So as you guys can see here, hello, and welcome to Creating a Blueprint for Financial Success. So my name is Jessica Sarter, and I am an agent with the Constitution Office of New York Life. So my role today is to provide you with information that can help you start and build a strong foundation that can get you onto the path to achieve your personal financial goals. So if at the end of this presentation, if you have any questions or you'd like to have a discussion related to any specific situation, I'd be more than happy to help. So you see here, my contact information is on the screen. You're more than welcome to jot it down and take that so that you can reach out to me if you need to. Just a quick disclosure. So this is an informational and life insurance sales presentation. And individual situations can vary. So the information presented nor the opinion expressed constitutes a solicitation for the purchase or sale of any specific financial product. So today we're going to give you the big picture of how to begin mapping out a financial blueprint for success. So whether you choose to do it alone or with the help of a financial partner like myself, today's presentation is going to help you build a strong financial future, and very similar to building a house, right? So you start from the bottom up. So anytime that you're building anything, you have to have a strong foundation, right? So when you have your plans or your blueprint, you lay a great solid foundation for a home, for a relationship, and your finances. So let's think about them as a house and let's go from there. So for our purposes, we've segmented our financial house into a few different core sections. So we will get into specifics about each section in a few moments, but in general, we always start with protection and making sure that you are covered for the uncertainties of life. And then we get to the accumulation phase, and that's the phase that most people are highly interested in. They're really excited about investing in their 401ks and putting money away to the side. So things like college funding and retirement planning. And then lastly, we always cover strategies to help you preserve your wealth throughout your retirement years, making sure that you can retire correctly the first time, right? So before we dive into the elements of a financial house, it's important to understand how you allocate your money today, your cash flow. To determine your cash flow, you must first determine your household income. So you start by calculating your household income, which is the sum of your take-home pay, which is the amount of money that you receive after taxes, your retirement contributions, benefits, etc., your spouse's take-home pay if you're married, or any other recurring sources of income that you may have. Next, you look at all of your expenses. So your housing, your food, your bills, include anything that you spend money on regularly, and then subtract that number from your household income figure. What you have left is your net cash flow. So once you know your cash flow, you can begin to figure out how much money you have available to save and spend. So some questions that you want to ask yourself are, what are my savings goals? What are my necessary expenses? What is a realistic spending target? So I want you guys to think about how many of you may have a household budget that you actively manage today. I know for me, sometimes it gets a little difficult. So, when it comes to the way people think about savings, there's normally two different types of people: those who spend first and save last, and then those who save first and spend last. So, up to this point, which type of person have you been? So you think about it. So one of our objectives in today's session is to help you discover the benefits of adopting the financial habit of saving first or paying yourself first and then spending last, because eventually that's going to help you build a stronger financial house for you and your family. So which, as you see, brings us to the foundation of our financial house. So that foundation is about financial protection. And financial stability starts by making sure that your lifestyle and your family are protected. So protection comes in all different pieces. So each thing that you see here on the screen, each one of these blocks is important, not urgent necessary. So they often get left to deal with someday. And someday I'll focus on that. But think about it. When is having an emergency savings fund urgent? When you have an emergency, right? But then it's usually too late. So you needed to plan for that difficulty when it was easy. That is true for all of the blocks. It's kind of like car insurance. We hate to have it, we hate to pay for it, but when we need it, we're like, oh my God, thank goodness I had it, right? The difference between car insurance and everything else here is that car insurance is required. We have to do that. So we're going to dive deeper into several of these blocks in just a second, but it's important to consider the others as well and work with trusted professionals to fill in those gaps. So make note right now of the ones that you do have, and then the ones that you don't have, and then the ones that you need to look over to see if you have the proper coverage, right? So the first thing is the will, power of attorney. A lot of people think that these are only necessary if you're rich. Let me assure you that's definitely not the case. A will is a legal document that makes sure that your wishes will be carried out when you pass away. In some cases, that may include like the transfer of money or guardianship of your children. And in other cases, it could be as simple as making sure that a treasured heirloom finds itself in the right hands. Power of attorney is a legal document that gives someone, usually a trusted family member, usually a spouse or a child, the authority to make legal and financial decisions for you on your behalf. This is really important for you in the event that you become incapacitated or no longer capable of handling your own affairs. Um, I always like to I always like to tell people about my own personal situation. I am currently power of attorney for my grandmother. And they did this back in maybe 2015. So about 9 years ago, I remember signing a document becoming her power of attorney. She has dementia now, so she can't remember anything past 5 minutes that you tell her. So 9 years it took for me to need to use the power of attorney, but she had it in place 9 years before she needed it. So very, very important, because without that document, there's a lot of things that I wouldn't be able to do for her. And it's really, really difficult to get those type of things in place once it's too late, because once you are mentally incapacitated, usually the court will appoint someone, and it might not necessarily be the person that you want to be handling and trusting all of your affairs. Um, so a serious risk here could be dying without a valid will or a trust, and that's called dying intestate. And it means, like I said, the court could decide what happens to your assets and who takes care of your minor children. And so to address any concerns in these areas, you would want to consult with a qualified estate planning attorney. Now, working with an estate planning attorney can cost sometimes thousands of dollars. So I always tell people, if working with an attorney is too much financially right now, there are apps that you can use. You can download an app on your phone to create a will of some sort, just so that you have something in place until you are in a financial space to connect with an attorney. Let's talk about the importance of an emergency fund. So when you're just getting started in your financial journey, Setting up an emergency fund should be one of your top financial priorities. So, as the name suggests, this money should only be used in case of an emergency, a rainy day, if you will. Examples: if you lose your job, become disabled, you have an unexpectedly large repair on your house or a medical bill. Most financial professionals are going to recommend that you set aside at least 3 to 6 months of your living expenses and put that into an account that's easily accessible and it's safe, preferably in something that offers you a high yield savings return. And that way, you won't have to go into debt when life throws you an unexpected curveball, which not so coincidentally leads us to our next topic, which is debt management. So, one of the best ways to get ahead financially is to make sure that you never fall behind. Unfortunately, there are all kinds of ways for people to get into debt these days. As you can see here, you've got your credit card, your mortgage, student loans, car loans, predatory debt. The average American has a total of $96,371 in debt. So, how much debt do you have? Um, some people have much more than that. Some people have much less. Wherever you fall on the scale of debt, the important thing is to realize that there is a way to develop a disciplined repayment strategy to get you out of that debt or to at least free up some of your cash flow. And that's something that a financial professional can work on with you. It's also important to consider disability insurance. So, just over 1 out of 4 people will become disabled at some point during his or her life. Most people hear disability and think car accident, but most of the time, disability happens when you least expect it and at any age, and it's usually not due to like an accident, it's usually due to health. So, whether that's, cancer or, any type of illness that you may come up with. But what would happen if suddenly you or your spouse suffered a debilitating injury or sickness that prevented you from working and you lose your income? How would that affect your living situation? Right? So, what would be the impact to those lost wages if one of the income earners suddenly lost their income? Um, Disability insurance is an important safeguard that can help protect you and your family by helping to replace a portion of your income in the case of illness or serious injury. A lot of employers will offer group long-term disability plans. They may or may not be available from your employer, but individual disability insurance can be purchased as a supplement to group long-term disability. Usually, your group long-term disability plans are going to cover about 67% of your income. That 67% of your income is then taxed. So, usually about 50% of your income. So I always tell people, if you can't live off of 50%, if you can't live off of no income, then you definitely need to sign into your group's disability plan at work. If you can't live off of 50% of your income, then you should definitely have a supplemental disability insurance plan that you purchase on your own that can then supplement that other 50% of your income. And then many people think the phrase long-term care refers to like a insurance, like a life insurance policy. So long-term care is insurance, but long-term care encompasses everything from long-term services like support and care. So where you will you live in a nursing home? Will you live at home? How will you navigate that myriad of legal and family and social dynamics along the way? So, in the event that you can't do 2 of the 6 activities of daily living here on the screen, so eating, dressing, bathing, transferring, toileting, or continence, once you can't do at least 2 of those tasks, you are eligible for long-term care services. Long-term care services can be very costly, and they are not typically covered under health insurance. So, we're not talking about you went to the hospital and had surgery, and then you needed to be in a rehab facility for 30 days. We're talking about you have dementia, you have Alzheimer's, you are 90 years old and can no longer take care of yourself on your own. Um, That's really, really important. And it's something a lot of people don't think about until it's too late to think about it. There should definitely be a plan in place for your family, a written plan for what happens when that time comes, because you want to get in front of it before you need it as, um, sometimes if you are expecting the government to take care of you, the government has requirements for assets. If you're expecting your children to take care of you, your children may have families and children of their own. So it's really, really important that you get in front of having that conversation with maybe your parents or even your grandparents on this call. Um, I think we kind of just covered that. Oops, sorry guys. All right, so what type of life insurance coverage do you have? That brings us to life insurance. You might only have it through your employer. You might have coverage that you took out on your own. You might have both, and you might not have a clue. I find that a lot of people, when it comes to life insurance, might have it, don't know how much they have, don't know the type of product they have, don't know what benefits they have, whether living or once they pass away. Life insurance can be a very tricky field if you do not understand it. And once you try to Google life insurance, it might make your head spin because there's very many different types. But when it comes to life insurance, the single most important thing to remember is that ownership matters. So most people are aware of two different types of life insurance. So that's usually life insurance that's provided by your employer, and it provides coverage on the employee. Sometimes the employer will pay for all of the insurance, and it usually doesn't require any underwriting. It provides basic temporary coverage. Since it's owned and controlled by the employer, the coverage can change at any time, and it also may terminate if you leave that employer. Another type of insurance is insurance that you personally own yourself. It usually requires some form of underwriting. But because you own it, you control the coverage, you can control any of the changes that there may be. And there are various different types of insurances that fall underneath that category. So life insurance does provide a source of cash. So depending on the type of insurance that you purchase, a policy that has cash value can replace the lost income of a wage earner, pay off outstanding debt such as mortgages, credit cards, student loans, keep your family in your home, allow your family to grieve without worrying about any bills that you may have, pay estate taxes or any other taxes, and maybe keep your business going until things can be figured out. Two main types of insurance are term and permanent. In case of both term and permanent life insurance, you are in control of the coverage because you personally own the policy. As long as you continue to pay your premiums, the policies will stay in force. We don't have time today to get into the merits of each kind of coverage and what they have to offer, but it's something that I would be happy to discuss in greater detail if anyone is interested in meeting separately. So now that you've seen the importance of a protection strategy, and how important that is to your financial foundation, we'll move on to the next level of your house, which is accumulation. Accumulation is, like I said earlier, about putting money aside to save for a specific long-term goal that you may have. And so today we'll talk about two of the most common goals that people most often save for, which is paying for college for a child and saving for retirement. So ask yourself, what is one of your priorities? Could it be saving for a child's education, retirement, maybe both, maybe neither? But let's start with paying for college. So with college funding, you're probably aware that college costs are escalating annually. Unfortunately, though, there are many products out there to help you set aside money for college tuition. In fact, there's so many different types that we can't get into all of them today, but you should take into account any primary sources of funds. For example, savings that you've currently saved and anticipate in the future, such as, grandparent gifting or any monetary money that your child might receive from gifts. So even if you haven't started saving for your child's education, or you feel that your current rate of saving may not be sufficient, it's never too late to set aside for potential other funds to support your child's educational future. There are, 529 plans that you could possibly do. Like I said, we can't talk about all of them, but Potential funding options are one of the things that we can explore together at a follow-up session. And just know that the average American carries about $35,000 in student loan debt. And so if any of you have student loan debt, you understand how crippling that can be once you become an adult. So anything that you can do for your child to help support them and set them up for success in that arena is always important. And then the retirement planning piece. So when you're planning for retirement, there's a couple of things to remember. The two main categories are three main categories are taxable, tax deferred, and tax-free income. So usually I ask people if I gave you $100 and you see these three buckets here on this page, where would you put that $100? And most people are going to say that tax-free column. But the thing that I have found in my financial career is that the majority of people don't have a tax-free asset. So, and usually that's because people don't realize that there are tax-free assets out there or how to utilize them or how to open them. But as you can see here, your taxable asset is going to be your personal savings. So when you save your money and put money into a savings account at the end of the year, the bank is going to send you a nice little form that you have to pay taxes on your earning. Any interest that they put into your account over a certain dollar amount is going to be taxed. And then you have your tax deferred column. People will put money in their IRAs, their 401ks, their 403bs, even your brokerage account, your investment accounts. You're going to pay taxes when you're ready to use that money, when you're ready to take that money out, whether it's in the form of long-term gains, capital gains, whatever that looks like, depending on the type of product you're in. You're going to pay taxes on it when you take it out. And then there's your tax-free income bucket, which is your Roth IRA or 401k, and then cash value life insurance. You can also get tax-free income from municipal bonds, but they're a little risky. So most people don't invest in those. But the Roth IRA and the cash value life insurance are the two main drivers of tax-free income in retirement. So with personal savings and individual retirement accounts, you can choose how you would like to invest. Employer-sponsored plans often have a selection of options for you to choose from. So you can't select the retirement plan or you can't select what you're invested in because they are pre-selected for you. And so usually I tell people you may want to consider a mix of solutions based on what your own personal risk tolerance are and the amount of time that you have for retirement. So the closer you are to retirement, the less aggressive you want to be. The younger you are, the more aggressive that you want to be. Not everyone needs to invest in the same things. Everyone's personal situation is completely different. So if you'd like to get a personalized look at your retirement savings progress, again, just let me know. I can set up something with you to help you with that. And now we come to the roof of our financial house, which is the preservation piece. And so as I mentioned earlier, one of our objectives today is to help you understand the benefits of developing good financial habits. And everything that we've talked about thus far, if you've put it in place, will help you, and it's designed to help you achieve this goal of preservation in retirement. So when you take charge of your financial house and you take charge of your finances, your cash flow, you're properly preparing for managing your risk areas, you're setting money aside for college and retirement, you're going to start accumulating wealth and an experience and higher level of financial freedom. So the tools to preserve your lifestyle and wealth. So we'll implement strategies to help you keep more of what you've saved. So this usually comes later on in life, usually when you are 55 or above. I start having these conversations with my clients about risk management, pension maximization strategies if you own one, required minimum distribution help, retirement readiness and budget analysis, and guaranteed lifetime income products. So the largest fear among people who are 55 to like 64, 65 years old is not having enough money for retirement. And a lot of times people will come to me at 55, 60 years old, and they're just now starting trying to plan for retirement. At that point, it's a little bit too late. Even if you start early, even if you put $100 away a month, over time, that savings adds up and it truly helps to build you um, a secure financial future in retirement. Please do not wait until you are 55 to start thinking about that. Um, so most people don't plan to fail. They just fail to plan, which is basically what I said. We don't take time to build that strategy. So the sooner you start, the better your outcome will be. So let's just review this financial house concept. Level one is that foundation where you prepare to manage any risks for emergency savings, such as life, health, disability insurance, long-term care insurance. Then level two, your contributions to college funding or retirement plans, or maybe investments that you have, brokerage accounts. I know a lot of people are talking about, Bitcoin and cryptocurrency is the new cool thing. So accumulation to help secure a future for yourself and your loved ones. And then finally, that level three, where we make sure that your plans come to fruition and we preserve the assets that you've worked so hard to build up. So I've had about 20 minutes with you guys here today. We've really only scratched the surface of a few of these concepts, but I hope that you are coming away with a better understanding of how all of these concepts work, and they've got you thinking about a direction in which you want your financial future to go. So preparation is key. The first step is to think about your goals and then prioritize them. Develop a strategy and take action, and then update and review your progress at least once a year. Whatever strategy is developed is an ongoing process. It's not a set it and forget it kind of thing. One thing about life is that it is not linear. Things are always changing, things that are in our control, things that are outside of our control, and we have to be able to flex and bend as needed along the way. So I usually tell people about my own personal journey right here, in that I became a client of New York Life about 12 years ago. It was right before my daughter was born. And I remember the financial agent reached out to me. And at the time, I was not making very much money. I was paycheck to paycheck. I didn't own a home or anything. And I was like, I don't know what we're going to talk about. I don't have any money for you. And I remember it like it was yesterday. He was like, well, do you want that to be a long-term problem or a short-term problem? And I was like, short-term. And so he was like, well, then we should meet. And every year, like clockwork, he would call me for our annual review, and we would have our annual review. And sure enough, things changed. I got a promotion, I got raises, I moved, I had my kid, I got divorced, I bought a home, I sold a home. I moved like 3 times. And still to this day, 12 years later, he still calls me. And I'm like, sir, I work here now. I think I can take it from here. But I say all of that to say that I'm in a much better financial space now than what I had been if I never took that phone call 12 years ago, if I never met with this man and thought about my goals and prioritized my goals and had someone help and support me along the way. Um, so having that ability to meet with someone, I don't think, especially in our community, I don't think as women, I don't think we even realize that there's someone like me out there sometimes that can help support us and answer questions that we might have along the way. Usually people think it's tied to, paying someone. The services that I offer are free. And there is someone like me, even if it's not with me, or someone from New York Life that can help support you along your way. So why work with New York Life? As you can see here, we are AAA rated among all of the insurance agencies and companies. So every decision we make, every action we take has an overriding purpose. Is to be here with you, our policy owners, when you guys need us. And so we've been protecting our policy owners for a very long time. I think about 177 years, since 1845 we've been around. So I understand that everyone's situation is different and your needs will vary. We're talking very generally here today. But like I said, I'd be happy to specifically talk with you about your situation afterwards if you feel like you need it. So continue to educate yourself. Think about your goals, prioritize your goals, develop a strategy and take action. Update and review your progress at least once a year. If it's not with me, with another financial advisor. And just make sure that you are crafting a strategy for yourself and your specific situation, and make sure that you get that education and that support that you need for yourself, because everyone's situation is completely different. And that is all that I have for you today. Thank you so much. And I look forward to seeing you again at the next session. Uh-oh, can't hear you.
I am so sorry, everyone. Thank you so much, Jess, for being here with us again this evening. Thank you to everyone who has joined us on tonight's call. And for those who are watching this pre recorded recording, thank you for joining the PMH Financial Series Blueprint for Financial Success. We hope today's session has provided you with valuable insights and actionable steps toward building financial stability and security. At Peaceful Minds Haven, we believe financial wellness is a vital component of mental and maternal health, helping to create a solid foundation for you, your family, and future generations. So let's continue empowering ourselves and our communities through informed financial decisions. Don't forget to follow up with any questions or connect with us for additional resources. Together, we can build a future where mental peace and financial success go hand in hand. And thank you once again for your participation. And we look forward to seeing you at our next session, which will be hosted on Saturday, February the 1st at 10 a.m. Again, the next session will be held on Saturday, February 1st, 10 a.m. Thank you, everyone.